still gets the glory and the victory. Thank you, Jesus. Hallelujah. As I was saying though, that if something was to happen, say unfortunate, like one person got sick, would the other person be able to go ahead and pay the bills, knowing when they were due, how much they're typically due, and what account it needs to come from? That's hard sometimes because you get accustomed to that one person doing it. Although it may be several people contributing to the income within the household, it's that one person that's solely responsible for it. But we have to do better when it comes to communication, when it comes to that. We need to try to make it where we have some type of system where everyone knows where things are due and what usernames and passwords are, so we can be able to make those things so we won't miss a beat. So we won't miss a beat.
I told Tanisha, we're guilty of that because in a lot of households, the woman normally handles and takes care of that stuff. We bring the money in and we put it in a pot, and they make sure that the bills are paid. I know, growing up, my mom, my dad never had to worry about that. He brought the money in, and but in today's society, everybody, both parties need to know because things happen in life, and it's unexpected, and you don't want to leave yourself. There's a saying that says you don't want to have to mourn twice. Right? You mourn the loss of a loved one, then you also now mourning because you don't know what to do next. So we always, it's better to be prepared and to have things in writing, have things documented, have things the way you want it to be in the event of God forbid something happening.
So a budget, what's that? A budget is a plan you write down to decide how you'll spend your money each month. So we believe in the 50-30-20 budget plan. 50% are your needs, 30% is your wants, and 20% are your savings. And so what falls along the line of your needs would be your mortgage, your gas and car maintenance, groceries, utility bills, insurance. You get the drift with that. Your wants would be travel, entertainment, luxury clothing. And if I had some of my other younger people, that would be every now and then Jordans, every now and then. And then saving, yeah, every now and then shoes. And subscriptions follow along. That's a want. That's not a need. All of us have been guilty of the Netflix and the Hulus and the Cinemax. And I just recently went through our budget and I said, we don't hardly watch Cinemax. I said, $12 gone, $15 gone, all these different subscriptions. I didn't even realize it really adds up. And I said, I'm saving some money there. And then saving 20% is savings. That's your 401k, your brokerage, your e-funds, and your investments. I'm drowning in debt.
You think about debt, and when you look at debt, most people don't understand it. It can be a simple situation to remove and to get yourself out of debt. We what we use is something called a debt stacking program. You look at how much money is being poured out on a monthly basis to pay these debts and to pay these bills, and you're looking at in this illustration here, this person's spending over $2,720 a month on their bills. And what we teach people how to do is take the smallest debt first, knock it out, right? Knock that smallest debt out, but don't take that 220 and get yourself in more debt. Take that 220 and add it to the next debt. Now you find yourself reducing, eliminating the credit card debt even faster. Now you've got 573 that you now have. Again, don't go get yourself in more debt. Take that money, add it towards the next debt, which is 551. So you're doubling what you are now paying, the 1124 for that car loan. So you're finding that that car loan is going to be knocked out even sooner. Excuse me. And that car loan now frees up $1,124 a month. Now you got $1,427. Now all your credit cards and all of that's paid off. Now all you got is a mortgage. You know what you can do now? Double up on that mortgage payment, right? So you turn a 30-year mortgage into a 15-year mortgage. So when you look at this situation, the debt which at your current state is going to be paid off in 23 years. That's age 58. 214,000 in interest that's going to be paid currently where you are now. Excuse me. With the debt stacking program, You pay it off in 9 years. 9 years, right? And versus 23. That's age 44 being out there, 14 years sooner, right? That means you can live out some of them earlier years and live it like it's golden, right? With the 130,000 in interest avoided. Continue to invest at 270 each month. At worst case, 9%. At 67, you're gonna be a millionaire. That's the show that says who wants to be a millionaire. It's a show, but at the same time, you can actually know how to do it, right, and walk that thing out. That's the beauty of it, right? Now, how many places can you go and not spend thousands of dollars for a seminar and learn how to become a millionaire? Multiple different ways, right? Okay.
So, how do we stay out of debt? We don't want to hear this, but we need to stay out of it. Do stick with the budget. Stick with the budget. Immediately pay off credit card balances. Create a large savings and or emergency fund. Use your savings for big purchases. Apply for lower interest rates on credit cards. A lot of times we look at how much is being offered and not really looking at the interest rate on the credit cards. And that is so important to look at that. Keep track of your credit score. Be smart and selective about new debts. Do not, we'll get to this later, do not let your insurance lapse. Immediately make expensive purchases or get new credit cards. That'll make sense later when it comes to purchasing a mortgage. Do not overspend and do not take on high risk investments. Your credit score. A credit score is a number that estimates how likely someone is to repay a loan. So, how many of you keep up with your credit score? It can be rather addictive sometimes, kind of, because that thing changes often. It don't take much to change. It don't take
Absolutely.
much,
Miss one payment. Next thing you know, your credit
and
score
it
off.
could be a day late too. It could be a day late, and it'll make a big. It could drop you 10 points
Yeah.
quick, quick.
So credit scores, when you look at credit scores, ranging excellent credit score will be from 780 to 850. I've never seen that, so I can only imagine, right? A very good credit scores from 740 to 779. Above average credit score 720 to 739. Average credit score is 680 to 719. Below average 620 to 679. A poor credit score 580 to 619, and very poor 520 to 579. And we're not even gonna talk about the worst, right? The worst means you can't even buy a stick of chewing gum, right? So we want to make sure that we stay in the green and stay out of the black and all the other colors, right? Green and above.
So having a good credit score is important because it can lead to better financial opportunities. It often means lower interest rates on loans and credit cards, higher credit limits, and better terms for renting or buying a home. So I want my own home. All right, I believe that's God's will for each and every one of our lives. He wants us to possess the land because that's his will. Home ownership is the act of owning the home where you live, which can be a house, an apartment, or other dwelling. It can be a significant financial undertaking, but it can also provide long term stability and wealth. This is all adding to your portfolio and your worth.
The benefits of home ownership: being able to have equity. Equity is cash in your home, right? Yes.
Yes.
Home value tends to increase over time, which can lead to financial security. Okay.
Well, the good thing about it, as a little testimony, importance about having equity in your home. So, Daryl and I, we moved into our home in, let's see, DJ, 2019, and as most of you know, Nightdale's really really growing, and in a matter of up to 2025, the home. We have about $200,000 to $300,000 of equity in the home. Just that quick. Just that quick. You have to and I mean, you have to be wise because some loan companies will try to get you to do a home equity loan too. I would not advise you to do that unless you make that your forever home. Unless you make it that your forever home. But it's good to know your home is valued at that. At least you know you could sell it for that. And that's a blessing in that. But that's all adding to your worth when it comes to your portfolio. Control, you can make changes to the property without needing permission from a landlord. Tax benefits. You may qualify for tax benefits. This is really good when it comes to itemization, when it comes to doing your taxes. And also community. Homeowners tend to stay in their homes longer, um, which can help build a sense of community.
So the power of ownership, right? The power of building home equity. If you look at the stat that you see here, over 30 years, home equity grows to close to $1 million. That's huge, right? Think about what you can do, leaving generational wealth. Generational wealth isn't always money. Generational wealth, you can leave a family member a house. You can leave them stock. You can leave them different things. Money's always good. Don't get me wrong, but all of those things equate right back to that cash.
So, the next one, we're talking about how your family really depends on you. Knowing that your family depends on your income for provision. God forbid something happened to you, how would they continue on financially?
There's a question that I've heard people say at funerals, right? Everybody knows their birthday, right? Everybody knows their birthday. On the count of three, shout out your birthday. One, two, three. June 29th. There's a dash there, right? And then there's a what? A death date. How many of y'all know your death date? Shout it out. I hope don't nobody know that. So what you always have to be mindful of is we know our birth date, but we most of us don't know our death date, right? So we have to be and use preventative measures to make sure that we're preparing in the event of premature death. And we do that through life insurance. Life insurance is one way to start building wealth. Uh, you find that a lot of other persuasions and a lot of other nationalities they show their family members how to build wealth through life insurance. And there's certain ways to build wealth, and there's certain ways to build wealth through life insurance, and there's certain ways that you will not build wealth through life insurance. Okay. How many of y'all know what life insurance is? All right. Anybody know what life insurance is? I'm gonna give you two words, and y'all gonna kind of laugh at it when you hear it. Right? Life insurance is free money. Right? Free money. And when you look at free money, some people say, "What do you mean free money?" What companies do is companies uh, when they sell you life insurance, they ask you, Mother King, how much free money can you afford to buy? Think about it. If you ever heard somebody say, I'm worth more dead than I'm alive, people have made that statement because right now they don't have $1 million. But if something were to happen to them, their beneficiary is going to get a tax free check for $1 million, right? So that's how most people start to build wealth for their next generation. Now, but who wants to die in order to leave wealth? You want to be able to enjoy the wealth with your family, right? But just in case your plan is not according to God's plan, you at least know you have preventive measures to make sure that you're able to leave them in a better situation. So when you look at life insurance, like I said, most companies want to know how much free money can you afford to buy, right? So when you buy life insurance, you buy a certain amount of money. Some people buy $250,000 of coverage, half a million, $1 million worth of coverage, and they might spend $100, $200 for that. But when you look at buying life insurance, you want to look at the two types. There's only two types of life insurance that exist right now, right? One type of life insurance that exists is called cash value life insurance. Now, I'm a life insurance professional. I've been a life insurance professional over 20 years. And our company always advises people that is an insurance that you do not want to purchase for four reasons, right? Well, first of all, when a person tries to buy you or sell you a whole life policy, there's four things they're going to tell you, Mother King. They're going to say, listen, Miss King, if you buy this policy from us, you're going to have life insurance for the rest of your life. Sounds good, right? Then they're going to say, if you buy this policy, it builds something called cash value. Sounds good still? A little bit, right? Then the third thing they're going to tell you is if you ever run into a situation, you can always borrow from that cash value. Yeah, that's the catch, right? Then the fourth thing they'll tell you is listen, you don't want to buy anything with term insurance because if at the end of the term, you don't have no more life insurance, right? Now let's look on the flip side of that, right? Now let me ask you a question, Mr. Spears. If you had $1 million at your disposal right now, would we be having a conversation about life insurance? Why not? Because you got money. See, when you got money, you don't need life insurance. Regardless, you don't have to have it. If you want it, that's a choice. It's better to have options and choices than to have to buy something. It's a difference, right? So that destroys that myth. Michael Jordan, Tyler Perry, these people that you see, big time actors and things, they don't buy life insurance. They invest, right? Wealthy people invest, right? Because they want their money to make money. Okay, so that destroys that myth. No one needs life insurance their whole life. No one. Okay. Second thing, it builds cash value. My dad taught me this a long time ago. He said, "What is cash value? Anybody here can raise your hand and tell me what cash value is. I got $100 for you. What is cash value?" Good answer. What cash value is, right? As Bishop would say, write this down or commute it to your memory. Cash value is an overpayment of premiums that you as a client pays for the life insurance. Now, let me ask you a question. Does that help you or hurt you? So you're going to overpay for a little bit of insurance but pay a whole lot for it. Does that even make sense? So does cash value help you or hurt you? Does it? You said that I didn't, right? Then they tell you if you ever run into a situation and you need money, you can borrow from it. Now, let me ask you something. Have you ever gone to the bank and went to the teller and said, listen, I need to borrow $1,000 from my checking account? You ever done that before? Why not? It's already yours. Now, mind you, when you bought life insurance, you understood life insurance is what? Free money. When you, it's like you buying a house, but you're gonna pay rent. Doesn't make sense, right? So why would you borrow from something that you already own? Not only that, when you borrow it, you got to pay it back at a higher rate than what it grew to. Does that help you or hurt you? Hurt you bad. So what would you say to someone that was buying cash value life insurance? Don't do it, right? So we believe in what's called buying term insurance and investing the difference. What's the difference? The difference is what you would have been spending for overpriced, high priced cash value life insurance. Term insurance is the least expensive insurance in the industry, right? So you can get two, sometimes three times the amount of coverage for the same amount of money that you were spending for a cash value or whole life policy. So that's just a little food for thought because any area that you can save money is money saved and that's money that can be invested, right? So the four problems that you find with cash value, one, like we said, is it's expensive and it typically provides you with less coverage. You have to borrow your own money. When we just talked about that's crazy. It typically has a low rate of return. And then last but not least, you lose the cash value if something were to happen to you. And with traditional policies and certain plans only, you can get your cash value back if you pay fees for it. Now think about that. I mean, does any of that sound attractive to you at all? Right? So if you can get three, sometimes four times the amount of coverage and be able to properly protect your family, that simply makes sense, doesn't it? Absolutely. All right. So when you look at buying uh, life insurance or buying, this is what we call the index universal life insurance policy. I'm going to tell you, anytime you see them long names, it's something behind it, right? Because with these policies, what's happening is they all fall under the preview or the preview of the whole life policy. The only difference is they're adding all these different underlining pieces to it to try to trick you. And a lot of times people don't find this out until it's too late. I'm now 20, 30 years older. I won't qualify for anything else. Or I'm too old to be able to get the coverage that I need for my family. So we tell people get the right coverage earlier in life And that way you can make sure that by the end of you buying that policy, right, with a term policy, no one needs insurance their whole life. We're going to show you how to match a portfolio with your life insurance policy so you'll never have to buy life insurance again. Doesn't that make sense? Absolutely. The theory of decreasing responsibility. How many of you have ever heard this theory before? It teaches you how life can kind of flip flop on you, right? You ever heard the saying, once an adult, twice a child? And what it means is you're young, your parents are taking care of you and what have you. And then as life goes on, you got your children, you're young, you got a high debt, you still got a mortgage. Loss of income would be devastating, right? So you buy life insurance, God forbid, in the event of you passing out of here too soon, right? We always pray Psalms 91 protection over all of our clients, but just in case it don't go the way we want it to go, they're taken care of. Then in the later years, it kind of flip flops. Those parents that took care of you, now you find yourself taking care of them, right? And rightfully so. If they gave you life, if they brought you into this world, made you the man or woman that you are today, then you rightfully should be able to take care of them in their later years. Because understand, if you live long enough, you're gonna get older, right? And you're gonna want somebody to take care of you in your later years. So in your later years, your children are grown, debts are gone, mortgage should be paid, retirement income is now needed. That investment money is protecting you from living too long. And some people say living too long. Yeah, the average life expectancy has gone down. How many of you know that? It's in the 70s, the early 70s. And what happens if you live into your 80s? Do you want to be just dumped off in a rest home? No, you want to be taken care of the way you want to be taken care of. Okay.
All right, here we are on to our next portion. We'll be done shortly. A will or trust, is this a necessity? How many know during the pandemic, a lot of what was a big deficit was, of course, a lot of people passed away, but they were uncovered, did not have their business in order, and it made it very difficult for people to handle things because they did not have a will or a trust in place. A will and a trust are both legal documents that can be used in estate planning. A will specifies how assets are distributed after death, while a trust allows you to transfer assets to a third party while you are alive. So here are some pros and cons to a will. You can make a will for free. You can write it out like you want to and just have it notarized. You can do it yourself, easy to make changes, and it also helps loved ones settle your estate after you die. The cons are it goes through sometimes a lengthy probate court process after the testator dies, becomes public record after the testator dies, and you can't protect assets from creditors, but you can't avoid estate taxes either with the will. With the living trust, the pros and cons. With the pros, you have if it's irrevocable, you can protect your assets from creditors. If it's irrevocable, you can minimize estate taxes. You can also avoid probate court, and you can also manage your assets if you become unable to manage them yourselves. The cons to this is it is expensive to create and maintain. It does provide, you also have to have legal assistance usually to establish it. And also, if it's irrevocable, it is impossible for you to change it after it's already been created. Invest.
All right, all right. So now we're gonna talk about a fun part. Talk about investing money, right? What? How many of you remember going to the banks back in the '80s and even some? I think in the '90s, you go to the teller, and if you got your kids with you, they give the little kid a little lollipop. You thought that was so cute. After you see this, you ain't gonna think it's cute no more, right? Now, what would happen is when you invest money, what banks particularly want you to do is take your money and put your money and invest it in the bank, right? And what they're gonna do is they're gonna guarantee you a very low rate of return, right? When you invest your money in the banks, right? That's traditionally what they would want you to do. But now think about this: how do banks stay so wealthy, stay so rich? They take your money and they invest your money in the global economy. So while they're guaranteeing you, your money's insured for a certain rate of return, right? So they guarantee you this rate of return, right? And then they get greater rates of return, maybe three, four, five times as much off of your money. They don't invest their money, they invest your money and they make money off of it. Banks, credit unions, insurance companies historically give you low rates of return. But what if you could bypass the middleman and become an owner, not a loaner, and be able to now invest for your own self and get the rate of returns that the banks get, right? That changes the whole dynamic, right? Now, look at savings versus investing. When you look at savings versus investing, both Kelsey and Kayla uh, save $500 a month. Kelsey saved her money in a high yield savings account at the bank. Both of them invested for 40 years. Kayla invested her money in a target date investment fund, earning 10% rate of return. Can't retire as she has 365,000 invested. That's not You're not gonna be able to have a comfortable retirement and stay retired. But now Kayla has $2.7 million. That's an excellent retirement. Savings is not enough. You must invest, right? So now think about this. There's a rule to money. We get ready to have some fun now, right? I got my man Maine here, and Maine is he's a hustler. He's a hardworking guy. He loves to have his money working for him, right? So now we taught Maine and his family what's called the rule to money. What's called the rule of 72. The rule of 72 teaches you take whatever you get at your lending institution and divide it into 72 to find out how many years it's going to take your money to double. Now, I'm going to put a bookmark right there because it's one thing I want you to always remember. There's a difference in you getting an interest rate, right? And there's a difference in you getting a rate of return. Okay? Now, the difference is you pay an interest rate. You pay. That's what you pay. You want the lowest interest rate you can possibly get when you buy a car, when you buy a house. You want a low interest rate. But when I invest money, I want to get the greatest rate of return that I can possibly get. That makes sense? Now that's food for thought that you'll never forget. Okay? So now understanding the rule of 72. When you understand the rule of 72, let's say for instance you came into uh, a nest egg of $10,000, right? $10,000 and you invest that money, you got three options. You can either invest it in the bank, and the bank says, hey, we're going to guarantee you a 3% rate of return, right? Now, what you have to understand is remember, the rule of 72 tells you take whatever you get at that lending institution, divide it into 72. Three goes into 72 24 times. So the question you have to ask yourself is how many 24-year doubling cycles do I have in my life? Ooh, that's a scary thought, right? So you say, nah, I ain't got time for that. Then you go to a credit union where credit unions are giving CDs and things like that are yielding maybe 6%, right? 6% money goes in 72 12 times. A little bit better, same amount of time, same amount of money, right? 160,000, but will you be able to stay retired with 160,000? Probably not. Stay right there. Anybody guess? Just guesstimate. Same amount of money, but now my rate of return is over 12%. 12 goes into 72 six times. So what do you think you're gonna have? Anybody? What you think you're gonna have? If you invest, go ahead. 2.5 million dollars you're gonna have if you invest in a. This is what the banks do. The banks get that 12% and they give you the three. Now anybody kind of see why they give you the little sucker? They give you the lollipop, right? The little dum dum. That's what they call it. So the question we ask is, how do you win a game if you don't know the rules of the game? Investing is a money game, right? And who benefits from learning this rule? Shouldn't we have learned this rule in school? That should have been a prerequisite, right? Just like math, reading, arithmetic, all that stuff, right? Without teaching your friends and family these concepts, how will they ever learn, right? So what we find is there are three particular type of savings programs you need to have when it comes to having a proper basic savings. One is an emergency fund. That's something that you set aside just in the event you need to uh, get a couple of tires for the car, something like that. You go to your emergency fund. Short term savings, right? Your short term savings says, hey, I got some money I want to put aside to buy a car or to buy a house, but I won't be ready for about another year. But I don't want to touch this money. Listen, money started to burn in my pockets up. right? So you want to set this money aside for a short period of time, but then you have your long-term savings that says, "Hey, I'm preparing for my winter years," right? So when I get older, I don't have to be dumped off in a rest home. I can live how I want to live. But that doesn't that sound better? See, like you can live like Mother King. Mother King listen, she living good, y'all. I'm telling you, she got that Chris money, straight off the mint, straight from DC. You understand? All right. So does anybody right now have any questions or comments that you may have for us right now? Okay.
All right. Definitely thank you for coming out tonight. Want to leave you with a few nuggets. Financial stability, which is what we're all striving for, is when all the aspects of your financial life are working together for your greatest good, your biggest benefit, and your richest life. So, final tips and takeaways. Choose carefully. Every decision has a cost, so be sure to consider your options. Invest in yourself. Education and training is your investment in you. Timing and transitions. Put yourself on a budget. Save and save more. Learn to invest. Plan your spending. Know the difference between your net and your gross. Regularly review and update your financial plan. Start an emergency fund. Set personal goals and save you for your retirement now. So we encourage you, if you want to do a financial needs analysis, both Daryl and I are here. We have a QR code up here. You can take a picture of it and it'll send you right to where you need to go, where you can set an appointment with us um, for your FNA, which is financial needs analysis appointment. Thank you so much for your time.